Before we start, quick thing. If you've ever driven away from a dealership feeling excited and then felt a small knot in your stomach a few weeks later when you looked at your bank account, this video is for you. And if that's never happened to you, stick around anyway, because by the end of this, you'll know exactly how to make sure it never does. Somewhere in America right now, someone is sitting in a driveway staring at a car they can't afford, wondering how they got here. They didn't buy a mansion. They didn't gamble their savings away. They didn't make one catastrophic decision. They just wanted a decent car, a safe one. One that wouldn't break down on the highway. One that looked like they had their life together. And now, every single month, a number leaves their account before rent, before groceries, before anything else, and that number keeps them up at night. Here's what this video is actually about. Not one irresponsible person making one bad choice. This is happening to millions of people right now, in 2026, at every income level, from people earning $30,000 a year to people earning $300,000. We're going to walk through exactly how the trap is built, the psychology that walks smart people straight into it. Who's getting hit the hardest right now? A real company collapse that exposed the whole system in public. And most importantly, the specific things you can do to make sure this never happens to you. Quick note before we go further, this video is for general education and information only. It isn't personal financial or legal advice. Loan terms and regulations vary by state and by lender, and if you're making a real decision about a car purchase or an existing loan. Talk to a licensed financial advisor or your lender directly. Now, if this kind of deep dive breakdown is useful to you, hit subscribe, because we're doing more of these. And if you know someone who's currently car shopping or someone who's stuck in a payment that's stressing them out, send them this video before they sign anything else. Okay, let's get into it. For most of the last century, there was an unspoken rule in personal finance. Never let your car payment become a second rent. That rule is dead. As of 2026, the average monthly payment for a new vehicle in the United States is around $770 a month. For a used car, it's over $500. And leases, which people assume are the cheap option, now average over $600 a month too, because lease costs have been climbing even faster than loan payments. Nearly 1 in 5 new car buyers is now paying over $1,000 a month for their vehicle. Not for a luxury car, for a car. And here's what makes this different from every other era of car buying. It's not because people are choosing more expensive cars out of vanity. It's because the price of an ordinary car has quietly become extraordinary. The average new car now costs over $50,000. 10 years ago, that same money would have covered a serious down payment on a house in large parts of the country. So, how are people affording $50,000 cars on wages that haven't grown anywhere near that fast? The answer is simple, and it's the whole reason this trap exists. They're not affording it. They're financing the illusion of affording it. Here's a trick that's been used for decades, but it has never been pushed this far. When a car becomes too expensive for the average monthly budget, the industry doesn't lower the price. It lowers the appearance of the price by stretching the loan over more years. 10 years ago, a 5-year car loan was completely normal, and a 6-year loan already felt long. Today, the average loan term has climbed to nearly 6 years, 69 months, and loans stretching to 84 months, a full 7 years, now make up over 1 in 5 new car loans in America. That's a record high. Some lenders, including certain credit unions, have started offering 10-year car loans. One industry veteran didn't hesitate to call that exactly what it is: a death trap for customers. On top of the term length, there's the interest rate itself, and this is where the gap between buyers gets brutal. The average rate on a new car loan is sitting around 6.5%. For a used car, it's closer to 11%. And for buyers with weaker credit, deep subprime borrowers are paying rates that can climb above 20%, more than 3 times what a buyer with excellent credit pays for the exact same used car. That means 2 people can buy the identical vehicle and end up with monthly payments that are hundreds of dollars apart, purely because of what's printed on their credit report. Here's why stretching the loan isn't a harmless convenience. A car starts losing value the moment you drive it off the lot. In the first year alone, it can lose 15 to 20% of its value. But on a 7-year loan, you're paying down that loan slowly, far slower than the car is losing value. That gap between what you owe and what the car is actually worth has a name in the finance world: negative equity. Being underwater. Upside down. And in 2026, this isn't a rare mistake. It's become the normal condition for a huge share of car owners. Nearly 3 in 10 trade-ins right now are underwater, and the average person trading in an underwater car owes almost $7,000 more than the car is worth. Now imagine what happens next. That person still needs a car. So what do? They roll that $7,000 debt from a car they no longer even own, into the loan for their next car. Their new loan doesn't just cover the new car, it covers the ghost of the old one too. And people who do this end up with average payments pushing past $900 a month for a car that on paper looks like it should cost far less. This is the mechanism. This is how the trap resets itself, loan after loan, without the buyer ever fully escaping. And here's the part that makes it so hard to notice from the inside. None of this requires anyone to do anything obviously wrong. No one skipped a payment. No one lied on an application. The person just needed a car, found a payment that fit their budget, and signed. The trap isn't triggered by a mistake. It's triggered by the structure of the deal itself, quietly working in the background for years after the signature dries. So here's the question that matters most. If this trap is so visible in the data, why do smart, careful people keep walking into it? The answer isn't stupidity. It's psychology. And it's psychology the auto finance industry understands extremely well. First, there's what behavioral economists call payment framing. Human brains are bad at evaluating a $50,000 decision, but very good at evaluating a monthly number. So, the entire sales conversation at a dealership is engineered to shift your attention away from the price of the car and onto the size of the monthly payment. What payment are you comfortable with isn't a friendly question, it's a redirection. Because once you answer it, the dealer can hit almost any price by simply adjusting the term length or the interest rate behind the scenes. Second, there's identity. A car isn't just transportation, it's one of the most visible signals of status a person owns. Where a house is private, a car is public. It sits in your driveway for the neighbors to see. It shows up in the work parking lot. For many buyers, especially younger ones building a career, the car becomes proof to themselves and to others that they've made it. That emotional pull is powerful enough to override a spreadsheet. Third, there's urgency and scarcity, tactics used deliberately in the sales process. Limited time offers. This rate expires today. Someone else is looking at this exact car. These aren't accidents. They're designed to compress your decision-making window so the rational, slower part of your brain never gets a chance to run the numbers. Fourth, and this one nobody talks about, there's convenience debt normalization. A generation raised on monthly subscriptions, buy now, pay later, and installment plans has been trained to see nearly everything in life as a manageable monthly fee rather than a total cost. A car loan simply feels like the biggest, most serious version of something we already do for our phones, our streaming services, even our groceries. There's a fifth force worth naming. Because it's the quietest one, the showroom itself is designed to make waiting feel like the mistake. The lighting, the paperwork already half filled out, the salesperson who's been trained for years to handle exactly this conversation, all of it is built to make walking out and thinking about it feel awkward, even rude. Very few people are equipped to sit inside that environment, under that social pressure, and calmly insist on doing the math themselves before agreeing to anything. That's not a personal failing, that's the environment doing exactly what it was designed to do. And it's worth saying plainly, none of this makes car dealerships or lenders villains in a cartoon sense. Most of the people working there are just doing their jobs inside a system that rewards closing deals, not protecting buyers from themselves. But understanding why the system is built this way is the first step to not being shaped by it. Put those 5 forces together: payment framing, identity, urgency, normalized debt, and social pressure. And you get millions of financially reasonable people making a decision that, viewed as a whole number, they would almost certainly reject. Not everyone is caught in this trap equally, and the data on who is struggling most is one of the most important and most underreported parts of this story. You'd assume the people struggling most are those buying luxury cars they can't afford. The data says otherwise. It's not about the car, it's about the credit behind it. Right now, delinquencies on subprime auto loans, loans given to borrowers with weaker credit, have hit their highest level in 32 years. Higher than during the 2008 financial crisis. Nearly 1 in 6 subprime borrowers is currently at least a month behind on their car payment. Meanwhile, borrowers with strong credit are, for the most part, doing just fine. The stress in this system is concentrated almost entirely among people who had the least room to absorb it in the first place. Younger buyers are especially exposed. They typically have thinner credit files, smaller down payments, and less negotiating power, which pushes them into higher interest rates and longer loan terms just to make the monthly number look survivable. The exact same car costs a first-time buyer meaningfully more per month than it costs someone with a decade of credit history behind them, simply because of how the loan is structured. And then there's a part of the lending industry most people have never even heard of, called buy here, pay here. Dealerships that finance the car themselves, usually to buyers with little or no credit history at all. Nearly 80% of the lending volume in this segment goes to subprime borrowers, compared to under 30% for traditional lenders. These loans default at nearly double the rate of traditional auto loans. And cars financed this way end up in active repossession over 16 times more often. For the buyers in this segment, the car isn't a step toward financial stability. For many, it becomes the thing that destabilizes them. This is the uncomfortable truth about the car payment trap. It doesn't punish recklessness, it punishes vulnerability. The people with the least financial cushion are systematically offered the worst terms and then blamed when those terms fail them. There's also a geography to this crisis that rarely makes it into the headlines. Delinquencies aren't spread evenly across the country. They cluster hardest in certain states, often the same states already carrying higher costs of living relative to local wages. Collections and repossession activity has stayed elevated specifically in loans written during 2022 and 2023, when vehicle prices peaked and lending standards were at their loosest. Those loans are now moving through what the industry itself calls their highest risk window, the stretch, roughly 3 to 4 years in, when negative equity is at its worst and household budgets have had the most time to get squeezed by everything else getting more expensive at the same time. In other words, this isn't a story that already happened and finished. It's a story still actively unfolding, with a very specific and identifiable group of loans working their way through the riskiest part of their lifespan right now. In September 2025, this entire system got a very public stress test, and it failed in spectacular fashion. A company called Tricolor Holdings had built itself into one of the fastest-growing subprime auto lenders in the country. Based in Texas, Tricolor specialized in selling used cars and financing them for buyers other lenders wouldn't touch, many with no credit score at all. And by the company's own disclosures, over half of its borrowers didn't even hold a driver's license. At its peak, Tricolor ran around 65 dealerships across 4 states, generated close to $1 billion a year in revenue, and had more than 60,000 loans outstanding. Then, almost overnight, it collapsed. Tricolor filed for bankruptcy and shut down completely, not to reorganize, but to liquidate. Banks that had lent Tricolor hundreds of millions of dollars, including major names like J.P. Morgan, suddenly found themselves facing steep losses. J.P. Morgan alone disclosed a loss of $170 million tied to Tricolor. Investigators later alleged the company had pledged the same collateral to multiple lenders at once, essentially borrowing against loans that had already been promised elsewhere, in what prosecutors would later describe as a systematic, years-long fraud scheme worth roughly $800 million. Executives were criminally charged. Why does this matter to a regular person who just wants a reliable car? Because Tricolor wasn't an isolated bad actor operating in a vacuum. It was the most extreme visible symptom of an entire system running on the same underlying pressure. Too many buyers who could not truly afford their vehicles, financed by lenders racing to write as many loans as possible, all resting on the same shaky assumption that the payments would keep coming in. What made Tricolor especially painful is who it served. This wasn't a company preying on reckless spenders chasing luxury cars. Its customer base was overwhelmingly people trying to do the responsible thing, get a reliable car to get to work, who had been shut out of traditional financing entirely, often because they had no credit history at all, rather than a bad one. When the company collapsed, tens of thousands of those borrowers were left in legal and financial limbo, unsure who even owned their loan anymore, while their cars, the thing they needed most to keep earning a living, sat as collateral in a bankruptcy proceeding they had no part in creating. The reassuring part, according to economists who studied the collapse, is that this isn't 2008 all over again. Cars aren't like houses. They don't depend on rising prices to make the math work for lenders, and the losses aren't spread across the financial system the same way mortgage debt was. But the warning inside the warning is this: an entire corner of the auto lending industry grew explosively by handing serious debt to people with almost no ability to absorb a financial shock. And when that shock came, tens of thousands of ordinary borrowers were left with loans in limbo, and vehicles they depended on for work suddenly tangled up in a bankruptcy court. The car payment trap isn't just a personal finance problem. It's a system-wide pressure point, and Tricolor was the moment it cracked open for everyone to see. This kind of pressure hasn't gone unnoticed by regulators either. Consumer protection authorities have flagged deceptive interest rate disclosures, wrongful repossession practices, and payment misallocation as recurring issues across the auto lending industry, and lawmakers have opened investigations into how repossession itself has become, for some lenders, a bigger and more predictable part of the business model than anyone previously realized. Whether that oversight tightens or loosens in the coming years, the message underneath it is the same. This isn't a fringe problem affecting a handful of unlucky people. It's large enough and widespread enough to have caught the attention of federal regulators and Congress at the same time. Even people who avoid every trap covered so far often miss the part of this story that turns a manageable payment into an unmanageable one. Everything around the loan. The monthly loan payment is only the headline number. Layered on top of it sits full coverage insurance, which lenders require for as long as the loan exists, and which has climbed sharply in cost over the last few years. Add routine maintenance. Add registration fees. Add the reality that many financed cars carry longer warranties precisely because buyers can't absorb a surprise repair bill on top of a car payment they're already stretched to make. When you add insurance to the average new car payment, some estimates put the real monthly cost of car ownership close to $1,000 before a single gallon of gas is purchased. There's one more hidden piece worth knowing about, something most buyers only hear about after they need it: gap insurance. That stands for Guaranteed Asset Protection, and it's specifically designed to cover the difference between what you owe on a totaled or stolen car and what the insurance company actually pays out, which, remember, is usually less than what you owe once you're underwater. For anyone financing a car with a small down payment or a long loan term, that coverage gap can run into the thousands of dollars, and going without it is one of the quiet financial landmines buried inside this entire system. This is why the trap so often looks survivable on the day someone signs the paperwork, and unsurvivable 18 months later. The loan payment was calculated to just barely fit the budget. Nothing was left over for the expenses that were never part of that calculation in the first place. One unexpected repair, one rate increase on insurance, one missed shift at work, and the entire structure buckles. So here is the part that actually matters. How does someone avoid becoming a statistic in next year's version of this same story? The first rule is the one the entire industry works hardest to make you forget. Think in total price, not monthly payment. Before you ever ask, "What can I pay per month?" ask, "What is the total number I am agreeing to pay over the life of this loan?" A payment that looks comfortable over 7 years can hide a total cost that would look completely unacceptable if it were shown to you as one number. Up front, the second rule is about the loan term itself. The shorter the loan, the faster you build real equity, and the smaller the window where you're at risk of owing more than the car is worth. Financial researchers are blunt about this. If the only way you can afford a car is by stretching the loan to 7 years, that's not a sign you found a good deal. It's a sign the car is outside your budget. Full stop. The third rule is to separate the loan to value math from the sales conversation. If a lender is willing to loan you significantly more than a car is actually worth, that isn't generosity, it's a warning sign, because it means you're being set up to start the loan already underwater. The fourth rule is the emotional one, and it's the hardest. Separate the car from your identity. The car in your driveway does not determine your worth, your success, or how your life is going. The most financially secure people are frequently driving the least impressive car in the parking lot, not because they can't afford better, but because they understand that the money not spent on the upgrade is the money quietly building their actual future. The fifth rule is simple, but rarely followed. Run the numbers before you walk into the building, not after. Know your maximum total price, your maximum term, and your walk-away point before a single salesperson says a word to you. The entire negotiation process is designed to happen faster than your rational thinking can keep up. So do the thinking in advance when no one is standing over your shoulder. There's a sixth rule too, and it's the quiet, unglamorous one that almost never gets mentioned in flashy financial content. Build the emergency layer before you take on the loan, not after. The reason a single missed shift or a single repair bill turns into a missed car payment is that there was no buffer sitting between the two. Even a modest cushion set aside before you sign is often the single biggest factor separating someone who weathers a rough month from someone who slides into the delinquency statistics we've been talking about this whole video. And if you're listening to this and you're already in a loan that fits everything we just described, there is a way out, and it isn't panic. Refinancing an existing auto loan, once your credit has improved or if rates have shifted, can sometimes lower your rate meaningfully without touching the term. And if you're underwater, the honest first step is simply finding out exactly how underwater you are, because the size of that number determines whether the smarter move is to keep paying it down where you are, or to make a change before it grows any larger through another rolled-over loan. None of this means never finance a car. It means financing one on terms you set, based on the full picture, not terms designed to make an unaffordable car feel affordable for exactly as long as it takes you to sign. Here's the uncomfortable truth this entire video has been building toward. The car payment trap doesn't catch people because they're careless. It catches them because the entire system, the pricing, the loan terms, the sales psychology, even the way lending has expanded to reach people who can least afford a mistake, is built to make an unaffordable decision feel affordable for just long enough to get a signature. Every piece of it works quietly. The monthly number hides the total cost. The long loan term hides the negative equity building underneath it. The identity pull hides the math. And by the time any of it becomes visible, the person isn't looking at a choice anymore. They're looking at a car they can't easily get out of and a payment that isn't going away. The good news is that once you can see the mechanism, it loses almost all of its power. A payment that's been engineered to look small can't fool someone who already knows to ask what the total number really is. A 7-year loan can't quietly bury you in negative equity if you already understand that's exactly what it's designed to do. The real skill here isn't just about cars. It's about learning to see through any number that's been shrunk down to make a big decision feel small. Because that same trick, in one form or another, shows up in credit cards, in mortgages, in buy now, pay later, in almost every corner of modern spending. The car payment trap isn't really about cars. It's about the gap between what something costs and what it feels like it costs, and learning to always look at the real number. If there's one thing worth carrying out of this video, it's this. The next time a big financial decision gets handed to you as a small, manageable-sounding monthly number, pause, ask what the whole picture actually looks like. That single habit, zooming out before you sign, is worth more than almost any other piece of financial advice you'll ever hear. If this video actually helped you see something you hadn't thought about before, that's exactly what it was made for. Like it, share it with someone who needs to hear it before they walk into a dealership, and subscribe if you want more breakdowns like this one. Thanks for watching, and I'll see you in the next one.